Warren Buffett is sitting on the largest cash pile in Berkshire Hathaway's entire history. And most retail investors have absolutely no idea what that actually means for what comes next. There's a behavioral pattern buried in Buffett's recent moves, one that has preceded every single major Berkshire acquisition for the last 4 decades. Most people are looking at the wrong data. I'm going to show you exactly what the Oracle of Omaha is really signaling right now, and why it could change how you position your portfolio for the next 12 to 18 months. Let's start with what we know for certain. As of the most recent public data, Berkshire Hathaway's cash and treasury holdings have surged past $334 billion. $334 billion. Let that sink in for a second. That's not a rounding error. That's not a temporary parking spot. That's a deliberate, sustained, multi-quarter buildup that Buffett himself has been reluctant to explain in full detail. And when Warren Buffett goes quiet, that's when you need to pay the closest attention. Now here's the first piece of tension that most commentators gloss right over. Buffett has been a net seller of equities for several consecutive quarters. He's been trimming positions, including his legendary Apple stake, while simultaneously refusing to deploy capital into new major acquisitions. 2 moves happening at the same time, both pointing in the same direction. Why would the greatest long-term investor in history be selling and hoarding cash simultaneously? The conventional answer is, he thinks the market is overvalued. And yes, that's partially true, but that's only half the picture. Here's what's actually more interesting. Buffett has publicly stated that he struggles to find acquisitions at prices that make sense. His exact framing at the 2024 Berkshire annual meeting was telling. He described the current deal landscape as offering unattractive prices across nearly every sector they've evaluated. He used the word unattractive 3 times in under 4 minutes. That's not an accident. That's a signal. When Buffett repeats a word, he means it. So now we have 3 confirmed data points. Massive cash accumulation, net equity selling, a stated inability to find value in acquisitions. Any one of these alone would be noteworthy. All 3 together? That's a strategic posture, not a passive one. And this is where the pattern gets genuinely fascinating. Go back to 2007, right before the financial crisis. Berkshire's cash reserves were swelling well above their historical average. Buffett was making quiet moves, not splashy ones. And then, when the world fell apart in 2008 and 2009, Berkshire deployed $26 billion in capital across Goldman Sachs, General Electric, and Burlington Northern, deals that generated returns that most hedge funds couldn't touch. He wasn't waiting because he was scared. He was waiting because he was ready. Here's a question that should be rattling around in your head right now. I'll get to that, but first, let's talk about something that almost nobody is discussing. Berkshire's operating businesses, the ones that don't get nearly enough attention on financial media, are generating cash at extraordinary rates. BNSF Railway, Berkshire Hathaway Energy, Geico, the insurance float alone, the amount of premiums collected before claims are paid out, sits at roughly $169 billion. That float is essentially free money that Buffett gets to invest. This is the engine that almost never makes headlines. But it's the reason Buffett's cash pile isn't just sitting idle. It's being used to generate more cash, which then fuels the next acquisition cycle. The flywheel doesn't stop. It just spins faster when markets get cheap. But here's what nobody is telling you. Everything I just described, the cash buildup, the selling, the patience, the waiting for the right moment, that framing assumes Buffett is playing offense. What if he's actually playing defense for the first time in his career? Here's the reframe. Warren Buffett is 93 years old. His longtime partner Charlie Munger passed away in November 2023 at age 99. The succession question at Berkshire is no longer theoretical. It is active and it is present. Greg Abel has been named as Buffett's successor to run Berkshire's non-insurance operations. Ajit Jain oversees insurance. But neither of them is Warren Buffett. Here's the uncomfortable truth that Berkshire bulls don't like to say out loud. A $334 billion cash position might be the greatest gift Buffett can leave his successors. Think about it. If you're handing off the most famous investment conglomerate in American history to a management team that has never operated without your shadow, what's the single best thing you can do for them? You give them optionality. You give them dry powder. You give them the ability to make one transformational acquisition that establishes their credibility on day one. You don't leave them scrambling in a fully deployed portfolio with no room to maneuver. The cash isn't just a bet on market corrections. The cash might be a succession strategy. That changes everything about how you interpret Berkshire's current posture. And here's why that matters for ordinary investors watching this video. If the cash is strategic and structural, not just tactical, then the deployment timeline is longer than most analysts are projecting. The Buffett is about to pounce thesis that gets recycled every 6 months on financial Twitter might be fundamentally misreading the situation. You might be waiting for a catalyst that arrives on a completely different timeline than the market expects. So let's come back to the open loop I planted at the beginning. The behavioral pattern hidden in Buffett's recent moves, the one that has preceded every major Berkshire acquisition cycle, is this. Every time. 1987, 2000, 2008. The sequence is remarkably consistent. Berkshire builds cash. Buffett expresses skepticism about market prices publicly. The operating businesses quietly improve their margins. And then, when the window opens, Berkshire moves fast and moves big. The difference this time is the succession layer sitting underneath all of it. That adds complexity. That potentially extends the timeline. And that means patient capital. Investors who can hold through uncertainty without flinching are the ones who get rewarded. Buffett has said repeatedly that his favorite holding period is forever. He's not managing to a quarterly calendar. He's managing to a generational one. The real question, and I want you to sit with this, is not when Berkshire deploys its capital. The real question is, who will be making that call? Because the next major Berkshire acquisition might not be a Buffett deal. It might be the first Greg Abel deal. And the entire financial world will be watching to see whether the Berkshire DNA survives the transition. What do you think? Is the $334 billion cash pile a sign of genius patience? Or is it a sign that nobody inside Berkshire can agree on what comes next? Drop your take in the comments. I read every single one. If you found value in this breakdown, share it with one person in your circle who follows Berkshire. That's how this channel grows. One sharp investor at a time. This video is for educational purposes only, not financial advice. Always consult a qualified financial advisor before making any investment decisions. Past performance of any individual or fund is not a guarantee of future results.